In this lesson, we will discuss the accounting for long-term contracts. By way of recap from last week's lesson, let's recall the two key points related to revenue recognition as follows. There are 5 key steps to revenue recognition. 1 is to identify the contract, 2 to identify the performance obligations or POs, 3 determine the transaction price, 4 allocate that transaction price, and finally the 5th one is to recognize the revenue when each performance obligation has been satisfied. Some other issues we talked about last week were recognizing revenue at a single point in time, or possibly over a period of time, such as the gaming subscriptions example. And finally, we talked about multiple performance obligations, where we use the price allocation methods, such as the residual approach. It's important to note that 1 out of every 8 public companies, or roughly 12.5%, have long-term contracts. So they're very common. Such companies would have been Raytheon, Oracle, and Hewlett-Packard. In dealing with these type of long-term construction contracts, the most critical part deals with steps 2 and 5 of the 5-step process we just reviewed. Step 2 is to identify the performance obligations. Step 5 is to recognize the revenue when each of those performance obligations has been satisfied. So now let's review some of the key accounting terms, because it's kind of unique for long-term construction contracts. The first account we want to talk about is construction in progress, or CIP. This is basically the contractor's work in process, or WIP inventory, that we see used in a manufacturing environment. Also, the periodic billings are booked to an account uniquely called Billings on Construction Contract, which is a contra account to the CIP asset account. Now, there's some interesting notes on long-term contract, which are as follows. Over the life of that contract, it may range from 2 to 5 years or more. The total billings are equal to the total collections. Secondarily, the gross profit is debited to the CIP, Construction in Progress account, to make it balance out. So there are 2 methods of revenue recognition under long-term contracts. The first one is what we call upon contract completion. This is when the revenue and the profit is only recorded at the end of the contract, thus the term contract completion. It's used only if a contract does not qualify for recognition over time. So again, this one is truly called the completed contract method. Our second method is over a period of time, which is used when any of the following 3 conditions are met, as discussed in last week's course. Service is performed over time. 2, the customer is using or controlling something while it's being built. And 3, the seller is producing a custom order. This is what we call the percentage of completion method. By the way, it should be noted that the new accounting standard, the ASU 2014-09, that we discussed last week, remove these 2 terms, completed contract and percentage of completion. While the journal entries are still the same, the proper terms, per the new standard, are revenue recognized at a point in time or over a period of time. So with the second method, the key issue here is how much to recognize each period. As we've talked before, one of the methods is to use an input-based measure, such as percentage of cost. So basically the period revenue, or the annual revenue, is equal to the total estimated revenue for the whole contract times the project to date, or PTD, cost percentage, less any prior revenue has been recognized. So let's review the key data for a long-term contract example, see if this makes more sense. Company X receives a 2-year contract worth $10 million. Here's the cost data for those 2 years, showing the following information, as you see on the slide. The annual cost incurred is basically $5 million in 2017 and $3 million in 2018. Thus, the cumulative cost after 2 years is a total of $8 million. The estimated completion cost of $2.5 million at the end of 2017 is then reduced to 0 at the end of the 2-year contract in 2018. So in summary, our total costs are basically $7.5 million as of the end of 2017, and then it grows to $8 million as of the end of 2018. Now this slide reflects the project-to-date cost percentages for each year as follows. In 2017, it's 67%, which is calculated as the $5 million cost incurred we just talked about, divided by the $7.5 million total estimated cost at that point in time. And then, of course, in 2018, which is the end of the contract, it is going to be 100% all the time. If I multiply those 2 percentages by the $10 million contract price, it results in the annual revenue recognition of $6.7 million in 2017 and $3.3 million in 2018. Now let's complete the solution for this example. If we subtract the annual cost incurred, given earlier, from the annual revenue just calculated. Thus, we reflect a gross profit of $1.7 million in 2017 and then $300,000 in 2018. In total, we reflect the $2 million of total profit, which makes sense. The total contract's worth $10 million and we spent $8 million of cost. Please note that the gross profit is booked as a debit to that CIP account we talked about earlier,